Hi, Adam Gower here. My guest today, Harold Hofer, is a return guest to the podcast, having first appeared when he was running Rich Uncles. Harold is among the small group of people who were testing crowdfunding ideas and execution pre-Jobs Act of 2012, and he has set up a new crowdfunding platform called Elevate.Money. In today's conversation, you're going to learn more about Elevate.Money, what kind of real estate they're looking to invest in, best marketing practices, and a whole lot more. To find out more about Harold and Elevate.Money, go to the podcast page at gowercrowd.com. While you're there, be sure to click on the subscribe button at the top of the page to gain access to our free weekly newsletter. It's the only one exclusively dedicated to real estate crowdfunding and syndication news and updates, where you will get information and resources that you can actually use. Subscribe there at gowercrowd.com. It's totally free. All right, now let's hear from former Rich Uncle, now founder and CEO at Elevate.Money, Harold Hofer. Here he is. Harold, it's so nice to meet you, actually. Last time it was entirely audio, as we discussed already. So it's nice to meet you by Zoom.
Yes.
I've got a question let's start with this. You are no longer my Rich Uncle. You are now Elevate.Money. How did you surf all the way from Rich Uncles to Elevate.Money? Tell me what the journey was across, and then we'll chat in some more detail about what's going on in the world.
Well, we started Rich Uncles, we being Ray Warda and myself. Ray was the chairman of CBRE at the time, retired as CEO, but still chairman at that time. And the idea was, could we, democratize investing in private real estate through a REIT format, marketed or distributed to the public over a digital interface rather than through some sort of financial services intermediary. So that was the original premise. And the spark that started that was the Jobs Act. Jobs Act came out in 2012, jumpstart our
business startups. It wasn't for real estate. That's why it's confusing.
But the Jobs Act, liberalized the way that people could raise capital. It made it easier to raise capital. It expanded, definitions under Reg D and whatnot. So we said, hey, this is let's give it a shot. So Ray and I started Rich Uncles in 2012, and our targeted customer was a baby boomer, somebody our age that may have had $3,000 or $5,000 sitting idle in a bank account, wanting to deploy some of that into real estate, and could have been a school teacher or a fireman or an accountant or somebody like that. So the target customer was a baby boomer, and we knew nothing about marketing, nothing about product, nothing about tech. It's like we were just totally flying blind. We brought on a third partner, Howard Mackler, I think in 2014. And Howard was a longtime friend of mine, still a good friend of mine. And he was a really smart marketing guy. But again, none of us knew anything about tech or product. We kind of were learning on the fly in a lot of respects. And we raised about $300 million from investors, about 15,000 investors over the Rich Uncles platform. And with leverage, bought about $500 million worth of real estate. Mm-hmm. And in 2019, we basically we merged our REITs and internalized the management company into the successor REIT, which is not an uncommon thing that happens in REITs. As they scale, they internalize management. So we basically sold the company, so to speak, to our REIT, and that's when I exited the company. And we've had a guy named Aaron Halfacre running Rich Uncles for us since that time. He has renamed the company Motive, Modiv, and he's been handling that since 2019, beginning of 2019. So during the course of my Rich Uncles tenure and experience, there were other things happening in a parallel fashion. One was the advent of robo-advisors, the idea for younger people to invest money in a stocks and bonds portfolio in small increments, without having to retain a financial advisor and an RIA or broker dealer to do that for them. They could do it directly online. Mm-hmm. And Acorns, we mentioned Acorns earlier. There was one of the earlier players in that space, but there was Betterment and Wealthfront and other players in that space. And the idea was, hey, we can manage your money for you. We have a staff of professors that put together algorithms to determine where to place the capital that you might give us based on your age and your income level and your risk tolerance and whatnot. So that whole thing was evolving. These robo-advisors were evolving alongside rich uncles at the time, and also trading apps like Robinhood. That was also evolving. So it became pretty clear that, to me at least, that, hey, Ray and I were targeting the wrong customer. We're targeting people our own age. We're kind of trying to force a square peg into a round hole because it's just not intuitive for people my age, baby boomers, to invest over a digital interface. But it was super intuitive for a younger person to do that. So after I exited Rich Uncles, I went and talked to Ray and say, hey, I think we should do this again, but we should really reskin everything and make it targeting a millennial audience rather than a baby boomer audience. So Ray's not involved in the company in a operational capacity, but he is an investor. So the idea was, let's do the same thing over again based upon the knowledge that I gained during my Rich Uncles experience, and try to use the best ideas that came out of the crowdfunding space. But let's really gear everything towards a younger millennial type customer. So I recruited two co-founders for this venture. One is Alex Cruttenden. So Alex is the son and brother of the Acorns co-founders, Walter, the dad, and Jeff Cruttenden, the brother. And Alex is one of their first employees. He was he's early 30s. So when Acorns started, he was early 20s. And, he was kind of around the kitchen table or the dinner table hearing about everything. And so he is our target customer, number one, but he also has an incredible intuitive sense about how to create a user journey that would be appealing to his peer group, somebody of his age. And so he's our product guy. And we have a marketing guy named Sachin Janjani. Sach is, mid-40s, just also a genius at marketing. I mean, it's interesting that, Ray and I were two real estate guys and didn't know anything about marketing or product or tech. We brought, Howard Mackler was our third partner. He was a marketing genius in himself as well. But, you really got to start these things having all the bases covered. Real estate, regulatory, that's a big part of the equation, but that's only half the equation. The other half is product, tech, and marketing. So I think we put together a founding team that covers all those bases. And really, we're dealing with three, certainties in our business, the way we look at it. One is a demographic certainty. That demographic certainty is that, baby boomers and Gen X, they'll control the majority of wealth in the U.S. by the year 2030. That is a demographic certainty. Baby boomers will age out of the workforce, make less money, they're going to die. Younger people are going to advance the workforce, make more money, and inherit money. So
exactly, that's the point, isn't it?
So
they're going to inherit.
Baby boomers and Gen X, it's a demographic certainty. That's certainty number one, is the demographic certainty that they're going to control the majority of wealth, within 10 years in the U.S. The second certainty is what I call a behavioral certainty. So this younger demographic, they're digital natives. They've never known anything other than being able to access the internet to do just about anything. And so they already are actively participating in other investing apps, Robinhood, Acorns, Wealthfront, Betterment. And so the idea is, let's present to that customer base, because Acorns and Robinhood, and they're only really selling stocks and bonds and maybe crypto now, but there's really no availability to invest in an alternative investment on those platforms. So the idea is, let's target a product design and a marketing campaign that targets that customer that already has an account with Acorns and or Robinhood and or Wealthfront or Betterment. And let's say, hey, just like every other generation ahead of you, before you, you should have some of your money working for you in private real estate, and let us be the conduit to do that. So the behavioral certainty is that generation is already accessing financial products digitally. They're not out looking for some financial advisor to manage their money for them. They probably would need $1 million account anyway for a financial advisor eager to take the business on to begin with. So it's the behavioral certainty. Certainty number two, the behavioral certainty, is that this target customer is already accessing products through a digital interface and has experience doing so. So when they see something like ours, it makes all the sense in the world to them because they've seen similar products for other investment types already. And then the third certainty in our business that we're relying upon is the concept of a REIT. So people talk about fractionalizing and democratizing investing through some of these apps these days that they'll they'll fractionalize a collectible like a basketball jersey, a signed basketball jersey, or a baseball card, or a Lamborghini. Well, let's put it in as tiny fractions and sell them to investors in $100 increments. Well, REITs have been doing that since the 1960s. So there's about $3 trillion of real estate in the US that's owned in this REIT format. And obviously, 2 trillion is owned in the format of listed public REITs on the New York Stock Exchange. That's known by everybody. But what's not as well known is about 1 trillion is owned in REIT format that's not on a New York Stock Exchange, a private REIT or a non-traded REIT. So that's a huge existing asset class with $1 trillion of assets under management. The concept of fractionalizing an investment class into tiny increments and allowing people to participate, that's already happened. So the third certainty we have is that a product certainty is that this product already exists that we're marketing to the public. And it has a long history, a long track record, and so it's a very popular investment product. That's why $1 trillion of US real estate is owned in this non-traded, this private REIT format. So we use those certainties, the demographic certainty, the behavioral certainty, and this product certainty to craft our current product for our customers. So that's kind of how we got started, and that's our goal. So
it's fascinating. So what asset classes are you chasing then?
Currently, so we are in commercial real estate, and we're focusing right now on what's called single tenant net lease. So one property, 100% occupied by one tenant. That's on a long-term lease, typically a large national credit-worthy, financially strong tenant. Could be a Walgreens. We own a Family Dollar, for example. It's one of our tenants. So they own 100% of the building. They're subject to a long-term lease. They're very strong financially, and it's called a triple net lease. So the tenant pays the property taxes, they pay the insurance, they pay the utilities and property upkeep and whatnot. So from our perspective, as to what product type to lead on our platform, we chose this asset class because it's income focused. So it generates a lot of current yield, dividend yield. It's safe typically because we have long-term leases, financially strong tenants. These are mission critical locations for these tenants that they spend a lot of time thinking about before they committed to go there in the first place. And so the emphasis is current income, secondarily capital appreciation. We have a product, and many people in crowdfunding space, this as well as anybody, Adam, are in the accredited investor only space, right? So you have a platform that's only accessible to effectively millionaires, and that's maybe 10% of the U.S. households that fall into that category. Our business model is, hey, we're open to everybody, right? So a subset of these crowdfunding platforms are open to non-accredited investors, as are we. So anybody can invest in our platform. Our minimum is $100. And there's a self-attestation representation the customer makes saying, hey, this $100 does not exceed the greater of my annual income or my net worth. And so that's a pretty easy hurdle to achieve. And effectively, anybody can participate in our product. And the idea is that, hey, you should have some of your money working for you in professionally managed real estate, and we're the conduit through which to do that. So we're on the non-accredited investor space. Compared to other platforms that are limited to accredited investors only. There's hurdles to overcome to participate in our space. You have to get your REIT qualified with the SEC. So there's legal things to be done there. You have annually audited financial statement requirements, which is great for the customer, protects the customer. We have to sell all of our REIT shares through a broker dealer. So we do. So all of our REIT shares are effectively screened by a broker dealer for KYC, AML, and suitability purposes, which again benefits the customer. And these rules and regulations are established by the SEC and FINRA to watch over these smaller customers, these smaller investors. And so there are regulatory, things we have to adhere to and comply with, which we do. So it's an extra cost to running our business, but we think it's worth it because we're building a business that's really effectively open to anybody, and there's really no excuse for anyone in the U.S. not to own some real estate, even though it's everyone's dream. Aspirationally, if you ask people, do you like vanilla ice cream? Yes. Would you like to own real estate? Yes. How do you do it, right? So vanilla ice cream, you go to the grocery store and buy some, but how do you buy real estate? Well, now there's no excuse not to own real estate when you have platforms like ours that are open to the public.
So are all of your shares sold through a broker dealer?
Yes. So our customers, when they onboard onto our platform, the information they give us, there's a multi-step process that you get from the customer in terms of their name, their social security number, they connect their bank account, what are their investment goals? What's their risk tolerance? There's a whole host of questions that we have to ask the customer. And those responses are then reviewed by the broker-dealer. So when you come to our platform and invest in our REIT, your money initially goes into an escrow account. It's connected directly from Plaid into our broker-dealer's escrow account. And the money sits there for 48 hours while the broker-dealer, approves or disapproves the customer. So some customers.
What would disapprove a prospective investor?
The name and the social security number do not sync. Maybe they transposed a digit or something like that. So they do a review of the customer, and so they may be offshore, not onshore. Our product's only available to residents of the U.S. and so there are things that people get bounced for, and typically they can be corrected. So a person transposed a digit on their social security number or whatever.
Right. So they get it wrong. So Harold, let me ask you this then. So if you are going through a broker-dealer, and in some cases we also work with broker-dealers, and some of our clients work with broker-dealers. Most of them, solicit investors generally, like general solicitation. They're online. Right. Those are the systems we build, is to attract investors to a sponsor. But if you're doing it through a broker dealer, what kind of don't they do all the marketing for you? Like what marketing? Do you
well, so there's two different types of broker dealers, right? So you have a broker dealer that's being paid a commission to market the product for you. That's not our model. Our broker dealer gets 1%. We pay them a fee. It declines based upon volume, but it's 1% until a certain volume is hit. Then it goes down on a monthly calculated basis. And all they do is the KYC AML suitability screen. So it's prudent for us to run all these shares through a FINRA licensed broker dealer, but they're not out there actively marketing the product, not being paid a commission to move the product. They are just a broker dealer of record, quote unquote, that is fulfilling the role of scrubbing these customers to make sure the product is suitable for them.
And Harold, is that a mandatory requirement for a private REIT?
Well, no, but in Rich Uncle's, we didn't use a broker dealer either. The SEC said they disagreed with our interpretation of something was called the issuer exemption, which you don't have to use a broker dealer if you're not paying anyone a commission and you're effectively marketing your own product on a platform. So we did that with Rich Uncle's. The SEC disagreed with our interpretation of the issuer exemption. So we're being extra cautious and not going down that path again. So
what are your, so tell me something. This was a conversation we had about Rich Uncle's that was absolutely fascinating. I'd love to have it again. Yeah. What are your marketing challenges at the moment? Is it, when you start up a platform like this, you've got to find deals and you've got to find investors.
Right.
So what are your biggest challenges at the moment in both those? I'm not suggesting you have any, but I'm just interested to know what's on your plate at the moment.
Well, distribution is the key, right? So I'm a real estate guy by background. Our chief investment officer, David Burduke, here at our company was also our chief investment officer at Rich Uncle's. So David assembled a $500 million portfolio for us at Rich Uncle's, highly experienced guy, very knowledgeable. So real estate is not a gating item. We're in this, we mentioned earlier, this single tenant net lease asset class. There's about $75 billion of annual transaction volume in that asset class per year. So always a lot of deals out there, a lot of product to buy. So we believe we have the real estate part of the equation wired. And the regulatory, when we talk about FINRA and the SEC and Reg A+, we believe we have that wired as well. Product, which is what Alex Cruttenden, the Acorn's son and brother, doing for us. I think he is a genius. That's our product user journey or user interface is as appealing and intuitive and friendly and gamey and sexy as any out there. So
I love it. But how do you find investors? What is your best pathway to find investors?
So right now our biggest success is on TikTok, believe it or not. So the idea is, okay, how do you find investors? We have people blogging, we have investors or people that are in our platform that are celebrities that are doing celebrity blogs for us. We market on Google, Facebook, Instagram, TikTok, but TikTok has been our best source of customers. And the idea is
is that paid or organic, Harold?
That's paid. Yeah. So we pay per click on that basis, right? And so whether or not, so the challenge is to get a potential customer to the platform to begin with. And once they're there, to make them feel good about investing with us and to actually become an investor with us and stay with us. So, our challenges are to secure the customer, number one. Number two is to have them, we have a monthly redemption feature, but the idea is that you should look at this as a long-term investment, not a in and out type investment from the customer's perspective. And we also encourage our customers to participate in this auto invest feature that we have. So you can give us $100 today, Adam, if you signed up on our platform, but also you could sign up for an auto invest feature. I'm going to give you another $50 every month, $25 every paycheck, twice a month. And so we already have we're already connected to your bank account via Plaid. So we just pull out the money on that basis. So right now, about every dollar we bring in each month, about 60 cents is from a new customer and 40 cents is from an existing customer that's participating in this auto invest feature program that we have, or reinvesting their dividends. So it's a very prominent feature with us. And the idea is that a $100 customer today at age 30 will be a $10,000 customer by age 40, $100,000 customer by age 50. And that the idea that you would ever go to a broker dealer to access this sort of product in 10 years is going to be like, I mean, they actually used to do that. And I kind of analogize it to like people that are driving electric cars like Teslas. I mean, they're never going back to an internal combustion engine car, never. And so my wife has an electric electric car, and the idea that you go to gas stations, Harold, every week. It's like I'm never doing 100,000 customer thereafter, and then you've got a big, huge, robust platform.
So when somebody comes into your platform, so you advertise on TikTok.
Right.
And presumably what that does is it opens a form of some sort that captures the lead, right? You've got that prospect coming in and they land on your platform. And of every, 100 or 1,000 people that actually land there, a proportion of them actually invest. So what is your conversion process for those leads? Is it fully automated, or do you have people that communicate by phone or otherwise, or like what does that look like from an investor's perspective?
It's fully automated, right? So our business model, we're using the breadth and scale of the internet to market this product. We don't have people on staff that are on the phones tracking down people that came to the platform. We did at Rich Uncle's, our model, that was our model at Rich Uncle's, and but our target customer doesn't need to get called to see if they want to invest in this product or not. They have their hand held. They understand.
So how are they responding? Are you sending them emails? Are you sending them texts? Like, how are you encouraging them to go from that, yes, I'm interested, to, here's my check?
If we capture their information, so they have to start the onboarding process before we would even get their phone number or their email address, right? So they have to have started the onboarding process. A lot of people don't finish. So we have, proportion that start and that don't finish. And so our goal is to get that percentage up. Right now it's running about 15%. People actually just interested in the process. They click on the investment process. And again, it's multi-stepped, keeping in line with FINRA requirements to all the information we have to capture. Mm-hmm. And so we have different points of fallout. So where do people fall out? People are hesitant about connecting their bank account via Plaid, even though it's a very universally accepted procedure these days for all these platforms. Some people still kind of are hesitant about doing that. So the idea is, how do we get that customer, how do we get that conversion ratio up from 15% of the people start the process at finish? How do we get that above 15%? Mm-hmm. And at Rich Uncle's, the average conversion time frame from when we captured the customer's information to when they actually became a customer, if ever, was 90 days. So some people converted day one, some people converted at month 6, but the average conversion time frame was 90 days. So if you're in our system, yes, you're going to get correspondence from us, emails, you're going to get texts from us, so, and the idea is at what cadence or frequency do we send out those reminders where it's helpful, not hurtful, where people say, stop bugging me, or, hey, this is really good. So that's all a challenge that we have. And we continually review on a daily basis data as to what's working, what's not working, and how to optimize and how to perfect all those practices and strategies.
Fascinating. Yeah, it's really interesting because you're in this, you really are in the democratization
Yeah,
business. When you're dealing with non-accredited investors, it is everybody essentially over the age of 18. With accredited investors, as you've said, it's a much smaller group. And so the numbers are a lot bigger. So of the people that, so to automate, you can only automate it. I mean, there's no other, especially if it's $100 first investment. Right? It's just, your cost of acquisition presumably is significantly higher than that, at least initially. So what proportion of people who sign up on TikTok actually enter the investment process that do so they give you the name and inbound, that way you can follow up with
right.
emails and with texts or whatever, however you're going to communicate. But what proportion of those people actually say, okay, they start the investment process?
About 10%. So if you go to our website, it's about 1 out of 10 people actually start the investment process on that day. They may start it later, but on the initial day, if you went to our platform today, you and 10 of your peers, one of you would actually start the investment process, right? Mm-hmm. So if you had 100 people going to your platform, and we have thousands come to our platform every day, but if you had 100 people come to your platform through TikTok, 10 would start the investment process and 1.5 would finish it, right? So those are kind of the metrics we're dealing with. So you got to have huge scale to get people to your platform to begin with. And we have to continue to perfect the customer journey, the user experience to make them start that investment process and complete it. So our challenge, my co-founder, Alex, our product guy, I say you have more job security than the Pope or the Supreme Court, because you'll never get it perfect, because you'll never end the perfection process of how to make this work even better and better.
Well,
and better.
not only
the
that,
challenge is always.
Yeah, but I mean, the other point is that the economy is constantly changing, so the messaging is constantly changing.
Yes,
people aren't static. The news cycle, affects how people respond as well. So. Yeah. So how do you deal with that? Like, for example, while we're chatting, I'm going to be a little bit rude, and I'm going to I'm just going to do a quick analysis of your website while we're chatting. But how do you communicate? Do you create content, or to what extent do you use content to communicate with your prospects? Kind of evergreen, and also on an ongoing, news cycle basis.
We have a twice a week email campaign cadence. So twice a week we send our customers something. So once a month, that as dividends have been paid. That's a once a month communication to our customers, whether they're an existing customer or prospective customer. We have a once a month email that says rent has been received. So the customers are aware that, hey, the rent actually was paid by our tenants this month, and that's now in the bank, and the dividends are coming shortly. And so, our overall pitch is that, hey, we are a conduit between corporate America, that by and large has elected to be a tenant of the real estate they occupy rather than an owner, and middle America. We kind of connect the dots in that regard. So out of 8 emails a month that our customers are going to receive, one is going to be, hey, rent came in, and number 2 is, hey, dividends have been paid. And then we got 6 others that are going to have some sort of topic associated with it. We had a recently 1-year anniversary email blast that went out to our customer base. So yeah, the idea is to pace the volume of communication to not overwhelm the customer, where they put you in a spam folder, but to actually engage the customer and encourage them to actually make the step and invest with us, or invest more with us.
All right, so let's drill down on some other things, if you don't mind. I've been looking at your website, and I love the letter that you put out there that talks about demographic certainty. It's a very interesting letter, so anybody that's listening should definitely check that out. What is your approach to debt? Let's talk about debt, because going into a world of rapidly increasing interest rates, this is a very important topic, and I know you have an opinion, so share it if you would, please.
Well, in our initial product type, I talked about the single tenant net lease, and why it's relatively on the real estate risk spectrum. It's kind of on the lower side of the scale. Hotels, in theory, would be the most risky, because the rent changes every day that you receive as a hotel owner. As a single tenant lease, the consistency of rent coming is highly guaranteed. We cap our leverage at 60% of the purchase price. So another metric by which we reduce risk is to not over lever our properties. So 60% is our leverage cap. We financed a deal earlier this year at 3.95%. That was where rates were, or 9 months ago or so. We're financing a deal right now at 5.5%. So that's, 155 basis points higher in interest rate. So, cap rates typically are 200 basis points higher than the interest rates, right? So the spread between the cap rate that which you buy a property, that's cap rate would be the first year unleveraged cash yield on an investment that you make. And so typically there's 200 basis point spread, and that's how you get positive leverage, that your cash flow on the equity piece gets magnified by the fact that the interest rate's lower than the cap rate.
So actually, so let me jump in there. So are you seeing then you're buying deals at 7.5 caps?
Not yet. So, that's a challenge. So the market has not yet, there's always a lag between interest rate movements and cap rate movements. Historically, there always has been. Certainly when interest rates are rising, sellers are hesitant to acknowledge that reality, and eventually they'll have to. Their broker is going to tell them, say, listen, the listing's expiring. Are you a seller or not? Cap rates have moved up. They're not going to come back down for another 6, 8, 10 years, depending on how long this cycle is. So real estate cycles typically, peak to peak or trough to trough are 10 years approximately in length. So if we're entering into a down cycle, coming up a high cycle, in the year 2020 was, let's say, a high cycle, or 2021, the next high cycle might be 2031. So sellers will have to acknowledge that, cap rates are going to have to rise. And that's going to happen. So we feel actually fortunate that we're relatively new. We don't have a legacy of assets that we effectively, with the benefit of hindsight, overpaid for over the past several years, because values have softened across the board.
Yeah, exactly. Actually, quick question. I wanted to ask about your long-term objectives, but before we do, just curious, on TikTok, what proportion of your prospects that come through TikTok are accredited?
They don't have to represent accreditation or not on our platform. I would say probably less than 10% of the general population is 10% of households are accredited. I'm not sure all the accredited investors are active TikTok participants. So
right.
they don't have to represent that they're accredited to us or not. So, but I'm going to guess it's substantially less than 10%.
Yeah. Okay. Yeah. That's what I was thinking. We've heard of TikTok and people talk to us about TikTok. I remember when you were at Rich Uncle's, you told me one of your best sources was advertising on radio. I think that was a fascinating insight. Is that something you've tried again?
No, radio. So another issue that we did with the benefit of hindsight incorrectly with Rich Uncle's. Radio advertising, you can radio advertise under Reg A plus under this testing the waters theme, but eventually you have to stop testing the waters and actually launch a product. So you can, in theory, radio advertise while you're trying to engage investor interest in investing or not in a product. But once you pull the trigger and say, yeah, we're actually launching a Reg A plus product, then you no longer can do that. So we're not advertising on the radio.
You can't do that. Why? Is that because you have to have some kind of immediate access to the...
The SEC says you have to have a simultaneous delivery of the prospectus when you make an advertisement or a solicitation. And then so over radio airwaves, you can't hand out a prospectus. You can't invest over the radio either, but this is, I'm not a lawyer or a legal expert in this area, but I think it's, the ability to, with one click, to be able to access the offer.
Yeah, it's funny you should say that. Actually, I've got somebody else, actually, Matt Belch of Caltier is on the podcast, and he has the exact same issue, completely different asset class. But he said, you've got to have has to be a button, one click, for when you solicit, that takes them straight to the SEC offering page, crying out, gazillion page, whatever. So what are the long-term objectives of Elevate.Money?
Well, we want to grow the business as large as we can. I think that as this demographic evolution continues to evolve, when I talked about first demographic certainty, and when I talked about earlier that millennials and Gen X will control the majority of wealth in the U.S. by the year 2030, and they are digital natives, right? So it's certainly number two is the behavioral certainty. I think that as that phenomenon continues to evolve, real estate services companies like CBRE, where Ray Werda, my Rich Uncle's co-founder, was chairman and CEO, they're always doing everything. So I think that an exit opportunity for a company like ours, or is for somebody like CBRE to say, listen, we want to provide an investment product. They're not just brokers and property managers. They're also investment sponsors at CBRE, typically institutional money. They sponsor investments for pension funds and endowment funds and invest, but this asset class, the ability to raise money from smaller investors over digital interface and deploy that capital. So I think that's going to be of interest to these larger real estate services companies that already do almost everything anyway. They're going to want to get into that space. So we see that as a merger candidate for us down the road, or an acquisition candidate for us down the road. Mm-hmm. Or some of the traditional robo-advisors that are in the space right now that are really just marketing stocks and bonds effectively through these robo platforms. They're going to want to not lose a customer off their platform to say our platform to invest in real estate. They want to have a one-stop shop, not just for stocks and bonds, but real estate, private equity, art, collectibles, whatever. So we think that's another exit opportunity for us down the road, that we'd get absorbed by a larger robo type company. The robo advisor phenomenon, just to digress for a second, that robos controlled $1 trillion of assets at the end of 2020. Or it's 2021. Anyway, at the end of last year, they controlled $1 trillion worth of assets, and it's supposed to grow to $2 trillion by the year 2025. Not sure that's going to happen given what happened in the market this year, but anyway, that ship has left the dock. This idea that these younger folks, the millennial, our target customers, are investing through a digital interface. That's a certainty, right? So it's only going to continue to grow, and there will be demand for real estate products. So we think that as we grow, that we would be a candidate for absorption or merger or acquisition by a larger player in the space that wants to create a real estate product for their customers, and not from scratch, but rather absorb somebody that already has already built. So that's kind of how we look. I think 2027. I mean, right now the mantra is stay alive until 25. Because
is that not heard that before?
That's market's tough right now.
It is.
And also fundraising for companies like ours is difficult. The VC communities have basically gone on hiatus a bit. So
what about raising from your audience though, from your TikTok audience? Can you do that?
I know Fundrise does that. We haven't needed to yet. So we've raised plenty of capital so far from friends and family. So that hasn't been an issue that we need to raise money through our own audience base. That's not a bad idea actually, but we haven't gone there yet.
People do that, there are a few. You wouldn't be the first, so you wouldn't be taking the slings and arrows of the pioneer.
Yeah.
Harold, let's wrap up with 3 rapid fire questions. And I asked you these last time. I can't remember what you said last time, so hopefully you can't either. Maybe things have changed anyway. 3 rapid fire questions. First one, what are your personal daily habits that make you productive and successful?
Well, I have 4 children total, 2 teenagers at home still, so I'm kind of bound by a schedule where I have to be around the house, kind of 9 to 5, whatever. But so I get up early every morning and I exercise. This morning, for instance, I ran in the rain and I stand-up paddleboarded. So I ran about 3 miles, stand-up paddleboarded 2 miles. And then I take my 13-year-old daughter to school. So I come home, get showered up, take her to school, and go to my office. That's kind of my routine. So exercising every day. I mean, I live in Newport Beach, California, and if you're not doing something outside every day, then you're missing out, in my opinion. I surf a lot. One of my sons is a real active surfer. He goes on his own, but I like to kind of tag along and surf with him when I can. So I surf a lot and mountain bike a lot. Ray Ward, I mountain bikes every day, but I mountain bike once a week or so. So staying active is doing something every morning is really kind of what gets my day going, for sure.
Lovely. Yeah. Second of my last 3 questions. What's been the hardest lesson you've learned in real estate? This could be something that's changed since last time, for sure.
Probably the same answer as last time, over leverage. So I had a company in the 80s that we bought a lot of property with high leverage. In the early 90s came the S&L crisis, when things ground to a halt. We had a lot of debt maturing in the early 90s where we couldn't refinance the debt because we'd over levered going into it. So I think, not getting aggressive on leverage is kind of the key. it's it's seductive. It's like I may have given you some analogy last time, but in mountain bike riding, speed is good until it's not. Same thing. Same thing with leverage. It's great when it's working, but it's not so great when it's not working. So that's why in this particular product, we cap our leverage at 60%, and the property values have to drop dramatically to go below that 60% level. So if we were levered at 85% or 80%, it's a different story. So I think don't over lever. Leverage is great, but when it's not great. So.
Final question. Advice for a millennial like me who is considering investing for the first time in real estate. What advice would you give them today?
I'd put $100 into our platform and get on our communications list, so you'll be hearing from us and getting educated about real estate investing. When we make an acquisition, we kind of announce why we make an acquisition. We have this, we call it Elevate Lens Plus analysis as to why we make an investment. We call it EL Plus, but it's on our platform, but it explains the criteria that we analyze when making a prospective investment, what's important to us and everything else. So, it's you can get access to our product for $100 and then you can get educated over time. And I think that's what you would do. If you're a millennial, do that. Give us invest $100, $1,000. But also get in the loop of receiving communication from us, because we are first and foremost a real estate company, right? We're just providing access to our product through a digital interface, but we're first and foremost a real estate company. And it's an opportunity for younger people to get educated, to learn a lot about real estate investing and that sort of thing.
Harold Hofer, co-founder and CEO at Elevate.Money. Thank you so much for being on the podcast. It's super nice meeting you.
Great talking to you. And best of luck healing up on that Achilles tendon issue there. Yeah.
Thank you. That was Harold Hofer, co-founder and CEO at Elevate.Money. To learn more about Harold, go to the podcast page at gowercrowd.com, and while you're there, click on the subscribe button at the top of the page to gain access to our free weekly newsletter. We're the only website exclusively dedicated to real estate, crowdfunding, and syndication news and updates, where you will get information and resources you can use immediately. Subscribe there at gowercrowd.com. All right, thank you, Harold. What a pleasure to see you again. Thanks so much for joining me. It was a pleasure to see you and to learn more about Elevate.Money. And I wish you the very best of luck with that new venture. And thank you, listener. I hope that you found today's episode as interesting as I did. Go to gowercrowd.com to find out more about Elevate.Money and take a look at their website. It's very cool. That's it for today. Be well, stay safe. And for now, this is Adam Gower signing off.